Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. In today's video, we're going to be looking at 7 companies that have the longest dividend growth streaks ever in America. These companies range from the utility sector to industrials and consumer stocks, and they have a pretty wide range of size as well. The smallest company on the list has a market cap of $1.7 billion, the biggest $400 billion. Their yields range anywhere from 1% to almost 5%. Some of them look undervalued today, others look more reasonably valued. And what's common across the group, I guess, is that they've all raised their dividends every year for about 70 consecutive years. That surprised me. I expected a little more variation here, but I think the reason why is the tax code underwent a massive change in 1954, and that's about 70 years ago. And part of that change involved the treatment of dividends. So when that tax code changed, you could begin to exclude from your income $50 of dividends each year, and you could also take a tax credit above that limit on the dividends you were receiving. So I think that kind of helped nudge some of these companies to begin having a more consistent dividend growth policy to attract investors. And the economy as well in America was doing quite well back then, coming out of World War II, gotten through the Depression era in the 1930s as well. So these are some really historic companies that have been great dividend growth stocks over time. And let's take a closer look at all 7. We'll start with American States Water at the top of our list. This business has been around since 1929, and it provides water utility service to 80 communities in California. It also has a small electric utility in the state. But what's unique about this company is here's a look at the map, by the way, of the different communities they service with water. But what's unique about this business is about 20% or so of its revenue is coming from this business they have, which delivers water services for a dozen military bases across the country. So this part of the company has faster growth, higher margins, so it kind of has helped the utilities expansion over time. And when you think about American States Water, it's unique in that its dividend has been growing much faster than a typical utility. So you can see these growth rates about 7, 8, 9% per year over the last couple of decades. And that's a trend likely to continue. Management targets at least 7% annual dividend growth. We can see the company's payout ratio here is below 60%. Most utilities are kind of in that 60 to 70% range. They're paying out kind of on the low side of their earnings. And those earnings are growing nicely. There's a lot of aging infrastructure this business has, things like replacing pipes, wells, tanks, storage. All those things help drive growth in the utilities rate base and earnings, which again are expected to rise 10% in the year ahead. This is a very financially conservative company as well, earning an A credit rating from S&P. And right now, shares are trading at a 2.2% yield, which is above the 5-year average. These water utilities have not really been in favor the last few years. The share price is actually below where it was 5 years ago. And if you believe that these companies kind of follow earnings and dividends over time, which I think they do, and the math kind of shows that as well if you get into it, this blue band here shows you what the stock price should be if this stock traded within 10% of its 5-year average dividend yield. A lot of these mature dividend stocks kind of maintain persistent valuation multiples over time, so they follow that expected value. That would put the stock price somewhere between $95 and $116 compared to a current price of $83. So water utilities are kind of an interesting niche. There's not too many of them. They own valuable water rights in this case in California and have kind of a long runway to keep making bolt-on acquisitions. It's a very fragmented market, and hopefully expand the number of military bases that are outsourcing their waste and wastewater system management. So that's American States Water. Next company on the list we'll look at is Parker-Hannifin. This company comes out of the industrial sector, and it's kind of a trickier one to understand. It does a lot of different things. So basically, if there's something that moves, Parker-Hannifin probably has some sort of component that's helping that equipment or airplane or what have you function. You can see it's pretty diverse across aerospace, industrial markets. If you look at some of the actual products the company has, they just cover so many different things. Valves, pumps, O-rings. They're in some data centers. It really runs the gamut, just trying to find these niche, mission-critical products that companies can't live without, that last a long time. The company builds up a huge installed base of products that its components are inside, and that kind of creates this sticky, recurring revenue pile. Now, the stock only has a 1% yield, which might disappoint some investors. The dividend growth rate has been excellent over time, compounding at a double-digit rate over the last 5 and 20 years. And this company doesn't look like the greatest value right now. The stock price has really taken off. I think there's some excitement about a couple of things here, both with AI. Parker-Hannifin does supply things like liquid cooling systems that are used in data centers. Not a huge part of their business. I think there's also just general enthusiasm about the industrial sector kind of seeing stronger growth here, recovering after a couple years of more sluggish performance. So Parker-Hannifin right now, I probably wouldn't buy the stock. It looks a little richly valued, but this is a great company, especially when there are concerns about the economy. The stock usually sells off and gives you a chance to own it. But wonderful business, very low payout ratio, near 20%. Earnings have grown very solidly over the last decade. This could be one to keep an eye on if you're looking for more of a growth-oriented stock. It should have a very long runway to keep compounding in all of its different markets. Next up is Procter Gamble, P&G. Looking at about a little under 2.5% dividend yield. Last hiked by 7% in April. Biggest company on the list with a $400 billion market cap. I won't get into all the details of this business, but you're going to be quite familiar with a lot of their household brands. Love's, Pampers, Downy, Tide, Cascade, Dawn. They just do a great job at maintaining essential products, putting a bunch of money behind advertising, which typically tops 10% of their sales is how much they spend on just advertising. They spend another $2 billion each year on R&D to try and improve their products each year and really lock down that key shelf space with retailers and maintain their pricing power, because consumers know to trust their brands and they want to buy them. They expect retailers to have them. The company went through a pretty remarkable turnaround almost a decade ago now, and growth was stagnating. They hadn't really invested enough in their products. This is around 2015, 2016. And the turnaround has been amazing. They kind of shed a lot of non-core brands and really doubled down on the ones they kept that they viewed as core. And earnings have almost doubled since that time, which is remarkable for a business this big. Sales have been growing as well. So this is a pretty defensive stock. It looks pretty reasonably valued today, kind of trading right in the middle of that expected price band. The 2% yield might not be super attractive, but it's a very, again, reliable defensive holding to have. While the dividend has been increased 68 straight years, it's been paid with no cuts for over 130 years, which is also one of the longest track records in America. It doesn't get much safer than P&G. So a defensive stock to keep in mind. Next up, we're back in the utilities space with Northwest Natural. This is the highest yielding stock on the list with a 4.7% dividend yield. That looks safe to us with a dividend safety score of 61. Now, you might be a little disappointed by this chart, though. The dividend growth pace has been quite weak, about 1% a year the last couple of decades, which is kind of making that high yield start to feel a lot less attractive. The good news is earnings have been growing faster than the dividend has. That's caused Northwest Natural's payout ratio to fall from about 85% a decade ago to a projected 71% in the year ahead. So it's kind of getting right back into that 60 to 70% band that most utilities try to hang within. Assuming that does play out, we could see dividend growth pick up a little bit and more track earnings growth going forward, but it's not going to be a super fast growing stock ever. The company's been around since before the Civil War, 1859, and it's very small. It serves about 2 million people in Oregon, Southwest Washington, and through a recent acquisition, it'll also have some exposure in Texas. That is Northwest Natural. Next up, we'll talk about Emerson Electric, going into the industrial sector here. This is another type of conglomerate company. I'll pull up a slide here from the deck that kind of shows a lot of what they do. So very global, spread across the Americas, Asia, Europe, and in a lot of different segments, everything from control products, automation, test and measurement, again, control systems and software. They've been moving a lot more towards automation, kind of reshaping their portfolio through some divestitures and acquisitions, but very entrenched business. Over 60% of revenue is coming from products tied to maintenance and repair, or recurring revenue in the case of software type products. So it's a very sticky business, only yields 1.6%, and dividend growth has been really slow for the last decade, really. But that's not because the company hasn't been growing. It's actually been a great stock. It's more than tripled in price over the last 20 years. It's just not really been growing the dividend very aggressively. So you can see that the payout ratio has come down from 60% to kind of the mid-30s range. So this company could throw off very substantial dividend raises going forward because earnings have been growing so strongly. Management has just chosen to kind of retain more of those profits, buy back some shares. But this could be a pretty strong dividend growth stock looking ahead. Shares right now have had a pretty good run. Again, kind of that industrial theme. There's been a lot of excitement about end market strengthening going forward. So shares don't look like an amazing value today, but this is a pretty interesting company that, again, is very essential in all sorts of industries, providing lots of essential products that various types of equipment and machinery really couldn't run without. That's Emerson Electric. Next up is Dover, another industrial conglomerate. That's kind of seems to be a theme in this part of the market we're looking at here. Dover's been around for almost 80 years now, and they provide a range of equipment, supplies, and services globally. The company itself has also, kind of like Emerson, a pretty slow pace of dividend growth in recent years. They've chosen to kind of hold back on that as well. I'm guessing we'll see the same payout ratio trend. Yeah, the payout ratio is very strong, very low at about 20%. So Dover has lots of capacity to significantly raise its dividend if it so chooses to. We can see the stock has gotten just a little bit ahead of that expected price range you'd be looking for. So not one I'd be looking at to run and buy today, but definitely a great business with a long-term history, again, of growing earnings, growing sales, buying back shares, and running conservative amounts of debt on the balance sheet. So that's a quick look at Dover. The final stock we'll look at here, Genuine Parts Company, has been around since 1928. This is a distributor of auto replacement parts and industrial components as well. It's kind of had a hard stretch recently. They've seen some softness in Europe, industrial side slowing down a little bit, caused a big sell-off in the stock earlier this fall. Taking a look at the valuation, we can see that the stock price has kind of tracked dividends over time, and with that sell-off recently, shares do look a little undervalued, assuming the long-term outlook hasn't changed, which we don't think it has. You're going to get about a 3.3% yield today. The dividend is well covered with the payout ratio near 50%. Genuine Parts maintains, I think it's a BBB investment grade credit rating as well. So the balance sheet looks okay with pretty reasonable amounts of leverage here. And the dividend has been compounding at about a 5 to 6% annual rate. I think that can continue once they kind of get through this period of mostly macro challenges. And when you pair that with a 3.3% yield, a dividend that looks quite safe still, it's really not a bad option. Not the most exciting company, but one that I would expect to be around a long time. Taking a quick look here at the business again, you can kind of see that it's spread mostly North American operations, but a bit in Europe and Australia as well. The company, if you're not familiar, both owns and supplies a bunch of Napa auto stores with parts that mechanics have grown to trust and that they can get with very short notice, which is really essential if you're repairing vehicles. And then on the industrial side of the business, it's a somewhat similar story, serving a lot of different end markets, being able to offer a lot of inventory on short notice to companies that need those parts to keep their equipment and machinery up and running. So a business that seems very likely to have a lot of staying power. Well, that's my end of the preview on all of these 7 stocks that have the longest dividend growth streaks in America. I hope it gives you some ideas on companies to explore further. And if you want to do that using our website, Simply Save Dividends, it's completely free to try. You can do a lot more than just research stocks on it. You can build and track your dividend portfolio, getting alerts when your payouts change, making sure you're diversified, checking on the safety of your income. You can screen for ideas as well, including closed-end funds. We have a lot of research that gets published regularly on the different 900 plus stocks in our coverage universe. There's also a quarterly newsletter with model portfolios you can follow along with. So it's really a one-stop shop if you're serious about generating safe and growing income and keeping that retirement portfolio on track. Thanks for watching, and I hope to catch you next time.